Happy Thursday. Hope you're doing great today, and thank you for joining live for yet another live event where we unpack passive investing, deal analysis, underwriting one step at a time. So, private credit has been in the headlines lately. I received a lot of questions from investors as of late, and frankly, it's been one of the more attractive income strategies over the past several years. But recently, the narrative has shifted. We're hearing terms like cockroaches and canaries in the coal mine, alongside rising default rates and questions around AI exposure and valuation. So, the question is, are today's best deals tomorrow's problem loans? And more importantly, what should investors actually be paying attention to right now? So that's what I'd like to cover in today's pop-up live. And for those of you who raised the question, I do appreciate you. If you happen to be joining in for the first time, or perhaps you don't know who I am, my name is Vessi Kapurian, a former commercial lender turned entrepreneur, advisor, real estate investor. Today, I work with family offices and their family enterprises at the board level. I selectively invest in multifamily. And I also coach and advise investors, specifically help them with deal reviews, capital call decisions for those willing to do a deeper dive. I also have a community that comes with a self-paced course where I help investors new to apartments learn how to analyze deals with confidence and ease. And last but not least, best-selling author of Mastering Multifamily Underwriting, 5 Steps to Confident Risk Smart Apartment Investing. So without further ado, let me start with this. Very important to distinguish that private credit is not one thing. It is a very broad category that includes everything from senior secured lending to sponsor backed middle market companies to asset backed credit to more complex structured vehicles. So when we see the headlines, they're usually, or at least in most cases that I've seen, referring to a specific pocket of the market and not the entire asset class. So in today's pop-up live, my goal is to separate the signal from the noise and focus on what actually matters from an underwriting perspective. So when you hear people referencing cockroaches, the idea is simple, that if you see one problem credit, there are likely others that have not surfaced yet but are just around the corner. And the canary in the coal mine is similar. It is an early warning signal, not necessarily a systemic breakdown. So I would frame a lot of the recent events that have surfaced as exactly that, early signals that require attention. I'm not saying ignore those, but they're not necessarily proof of a broader collapse. So first, let's look at the data. So Fitch reported that private credit default rates reached approximately 9.2% in 2025, which is up from about 8.1% the prior year. So defaults have increased. This is a fact. This is real. However, there are two important nuances to think about as you peel the onion on the data. First, the defaults have been concentrated with smaller borrowers, particularly those with lower EBITDA or EBITDA levels, 15 million or below. And secondly, in many resolved cases, especially for first lien loans, recoveries have remained actually relatively strong. So while defaults are rising, realized losses have not necessarily followed at the same magnitude, or at least not yet. There are also forecasts that defaults could move towards the high single digits depending on sector exposure. So that is not to say that those headlines should be ignored. You absolutely have to pay attention to those, and we're clearly in a more distressed environment. That's a fact, but not necessarily in systemic crisis, or at least not yet. So, where do I think investors should be paying close attention to when it comes to this particular sector. Now, one interesting stat that I saw is that private credit's exposure is very meaningfully concentrated, roughly 20% or even 40% if you look at the broader tech and business services sector, but very meaningful exposure to software. And why that matters is you unless you've been living under a rock, right? You've heard about AI, and AI has started to disrupt certain software business models. So, what used to be viewed as stable, recurring revenue business may not be as durable as previously assumed. At the same time, not all exposure is equal. There is a difference between a cash flowing service business, a software company facing disruption, or a real asset backed loan. So the nature of the collateral is also important here. And they all sit under the private credit umbrella, but the risk profile within each of these business segments is very different. And so this is where underwriting and credit risk and portfolio management become critical. In a rising or peak market, many deals can perform reasonably well, but as conditions tighten, that dispersion really matters. So, from an investor perspective, the question I will be asking as I evaluate some of these opportunities for my personal portfolio would be what exactly is being financed, how durable is the cash flow, what is the margin of safety, what is the sponsor support, what is the loan structure, and the covenant package, because a 9% yield from one manager is not the same as a 9% yield from another manager. And the difference is really what lies underneath the surface. Now, the other idea that or item that deserves close attention is structure. And not all private credit funds are created equal. And so, some key questions to ask there is what is the fund level leverage? Or is the fund leverage? In many cases, they are, but not always. Is there back leverage or financing layered on top? Are there secondaries or other structure exposures that reduce transparency and increase risk? And most importantly, what are the liquidity terms relative to the underlying assets? Because private loans are inherently illiquid, right? Once you commit a loan, unless the borrower is in default, right, you cannot just yank it underneath them, right? You're committed, and if they're performing, right, you cannot just pull the loan back. So I cringe when I hear people referring to it as clipping coupons. And yeah, that may be the case if everything is going right. Absolutely, yes. If the borrower is performing and paying their loan on time, yes, you could be clipping coupons, but that is not necessarily guaranteed. And also, when it comes to liquidity, oftentimes I see these vehicles marketed as evergreen and flexible redemptions and this and that. And yes, many of them offer periodic liquidity, but it's important to understand how that is managed during periods of stress, what the lockup periods are, what the notification periods are, if there are caps, usually there are, on redemptions, and also how the valuations will be performed at the time of valuation, at the time of the redemption, because unlike public markets, valuations in the private space are not continuously marked. So you're really relying on the manager's discipline, reporting, and transparency to share with you how that is done. And oftentimes that will be in the reporting, but it's not always easily discernible. Now, I'm often asked, are we looking at a situation similar to 2008? And to be honest with you, I don't quite know yet. Now, a lot of the articles and publications that I've read suggest that this is not the case, a lot of it being predicated on leverage. But even leverage or leverage on leverage can be measured differently. A lot of that lies into the disclosures, which are somewhat opaque in the space, not easily read or discerned. So many funds are indeed carrying additional leverage, or like I said, investing in secondary, tertiary vehicles. And so That doesn't, while the publication suggests we may not be there, that doesn't mean that there is no risk. Again, because of the opacity of the structure. And so I would not dismiss the risk. Hard to say if we're at 2008 levels. Doesn't feel like it yet, but I will honestly say I haven't formulated my opinion. So while I love private credit, some of those concerns that I shared with you have been and are on my radar. So, leading to the next question is it a good time to invest in private credit? And the answer is yes, but with anything, you have to do this very selectively. This is no longer a simple yield story. Obviously, rates have declined, and with that, so have yields. The manager selection and the underwriting story here is key. So I do think the opportunity is still there, but the gap between strong and weak deals, strong and weak managers is widening. And so the focus should be on what are you lending against? Really understand the underlying asset class. How are these loans structured? How is the risk being managed? How is the portfolio being monitored? Because in this environment, that is what will ultimately determine the outcome. So, private credit is not a single asset class; it's a spectrum, and where you sit in that spectrum matters more today than in prior years. So I hope you found today's pop up live helpful. Please keep your questions and comments coming. This is really what's inspiring a lot of these pop up lives that I hold once a week, usually Thursdays or Friday afternoons. I am subject to travel and meeting schedules. I enjoy interacting with you. So if you have a topic or a question, definitely message me or put that in the comments below. If you'd like to be notified of future events, I encourage you to follow me on LinkedIn and YouTube and hit that notification button so you don't miss future live events. And if you do have questions, I always enjoy talking markets, and especially if you need a second set of eye review on a potential investment opportunity that you are considering, especially in the apartment space, you can always message me. I enjoy these conversations. And until next week, I wish you a beautiful day and a beautiful weekend. Ciao.